Good morning. This is Brian Split with Allendale. Today is Friday, March 1st, 2013, and I'm here bringing you your morning coffee. Looks like we do have the macro headwinds in the market right now providing a bearish influence. A couple things we're looking at this morning, some disappointing manufacturing data out of the Eurozone. We had Brazil report some of the worst economic numbers in the last 3 years. And we also have concerns over the budget cuts that are looming over the U.S. economy. Approximately $85 billion in spending cuts are possible. We do have lawmakers meeting today, and those spending cuts are gradual, so it does give them some time to reach a deal. Going back to the Brazilian issue for one moment, what that has caused in the recent trade is the Brazilian real to be trading rather weak against the U.S. dollar. Something that we've been watching relating to the soybean market recently has been the port delays. And again, we're hearing anywhere from maybe 40 to 90 days of congestion at the port. But from a Forex perspective, the recent weakness in the Brazilian real and the strength in the U.S. dollar does give Brazilian exporters a Forex advantage. So that is something to keep in mind. We may see hand-to-mouth business being done from the U.S. because we can get the beans out quickly, but any long-term purchases will most likely be done by from Brazil because of that. The South American rain situation, as far as the dryness in Argentina, we do believe that the weather issue down there has come to a stop. We have been trading some strength in the soybean market and corn recently with concerns over dryness in Argentina and some excessive rains in Brazil, which we have heard some grumblings of causing fermentation in some of the beans. But we do look to see some of those areas that have been wet in Brazil dry off, and areas in Argentina have gotten some rain. So we do believe that the apex of the weather market for South America has come, and that the next weather market potential would be as we move into our own planning time frame for the U.S., and then possibly looking at the long-term ramifications of the dry situation and how we're going to go through reproductive stages this summer. Moving on to where the markets are trading currently, we do have May corn down just about 3 cents. We're holding just above last week's highs, which we were able to take out last night, or I should say yesterday, during the day session. And we did fail at about the 50-day moving average overnight, so we are going to see some resistance there. Long-term support in the May contract is down at the 680 level. One thing that has given a rise to prices recently has been the lack of delivery intentions on the March contract. There were no deliveries overnight. There were no deliveries on soybeans, although there were 471 contracts delivered against the March wheat. So we're going to continue to keep an eye on the delivery situation. Any lack of deliveries in a vacuum without any kind of a macro influence should continue to provide support to the grain market in general. As far as the May soybeans, we are finding a little bit more pressure. Again, a lot of that probably has to do with the weakness in the real and the better weather situation that we're seeing in South America. The May contract is finding support at the convergence of the 200 and 50-day moving averages near the 1425 level, and we do see long-term resistance at the $14.90 to $15 level. As far as the wheat contract is going, the market is in one of the most bearish trends in commodities right now on both the Kansas City and the Chicago wheat. We do have the funds net short. Any type of short covering could provide some quick bounces, but overall the market is in a downward trending market, and we do have the recent weather as mostly a bearish influence over the potential wheat growth in the plains. So we'll keep an eye on that. Again, we're going to start getting numbers as far as the crop conditions as they come out of dormancy in the next couple of months, and that's going to be something to watch. Typically, the good to excellent ratings prior to dormancy don't have a really long-lasting impact on the yield that we see at the end of the day. We really want to pay attention to the good to excellent ratings as we come out of dormancy, as that statistically has the most impact on the actual yield. As far as the meat markets are concerned, we do have cash cattle trading $3 to $5 higher than last week. 128 is traded in the north. Box beef was up, choice up 59, select up 89. Hog packer margins are positive $10, so we're watching that. Both the cattle and the hog markets have been trending lower over the past month, and we do have some fundamental targets higher in the April cattle near 132, so we're looking for a little bit of a rally in that market. And we're still watching an issue in the Eurozone as far as the way that the hog animals are being bred there. That we believe long term will reduce the production out of the Eurozone, which is the second largest exporter of pork. Lastly, we do ask that you please take advantage of our planning intention survey. The more help that we get from you, the better results we'll be able to provide, and the better our numbers, the better we can help you making longer-term marketing decisions. So again, you can reach us at 1-800-262-7538. You can also do the survey online at www.allendale-inc.com. And good luck trading at the first day of the month. Thank you.